Hello and welcome to the Master Later Life Lending podcast, where we explore the dynamic world of later life lending, equity release, and the evolving needs of borrowers that are over the age of 50. I'm your host, Paul Glynn, and I'm thrilled to have you with us today. In this episode, we're diving into the characteristics and financial profiles of traditional equity release customers and the innovative solutions for emerging later life customers. We'll address the myths and the misconceptions about equity release, explore demographic trends, discuss newer products like retirement interest only and term interest only mortgages. And joining us today are Colin Bell from Perenna and Emma Graham from Hodge. Perenna is a mortgage lender offering innovative long-term fixed rate mortgages to provide stability and certainty to borrowers. And Hodge is a leading specialist in retirement interest only mortgages, later life lending solutions, and is dedicated to helping customers achieve their financial goals. So without further ado, let's get started and welcome our guests, Colin Bell and Emma Graham. I'll come to both of you in a second to give a little bit more detail on the offerings from each of your organisations and a bit more about your roles. But let's get started. So Colin, if we come to you first, tell us a bit more about you and a bit more about your organisation and the role you perform in it.
Yeah, hi, thanks for having me. Colin Bell from Perenna. I'm one of the founders of Perenna and the COO, so I'm looking after the customer journey really, from the front end right the way through into underwriting, operations, collection servicing, as well as the technology estate. There from the start, got a banking license, and here we are now live and lending.
Brilliant. Quite exciting to join a new organisation and be part of that from the ground up. So fascinating to hear more about that as we move through the session. And Emma, tell us a bit more about you and your role in your organisation.
Yeah, hi, I'm Emma Graham and I'm a Business Development Director at Hodge. I've been at Hodge now for just coming up to 5 years. Prior to that, I was in the kind of like mainstream lending landscape. I used to work for a mutual building society. I did have a brief stint working in the UAE within a mortgage product capacity as well, but it's been pretty much brokers and mortgages for the last sort of 25 years for me. And I think in terms of our offering, yes, it's very much about, meeting those changing needs of borrowers over the age of 50. We've got the Rio mortgage, term interest only and so forth. And looking forward to having a good conversation about that.
Brilliant. And thank you for both of you for spending the time with us today. It's brilliant to have one of our newest ambassador partners and one of our longest standing ambassador partners with us today. So let's get straight into it then in terms of the questions. So AIR has spent a lot of this year talking about a comprehensive conversations movement and how important it is to put affordability at the heart of the process for firms to make sure they're asking all of those questions around what customers can afford to pay and want to pay and putting the right challenge in at that point in time. And all of that really is designed to flush out two or three things. The first is to make sure that the breadth of product options from traditional mortgage world through to later life lending are open for that customer for as long as possible. Secondly, to ensure that that customer understands the implications of picking a roll-up product versus a more traditional product in the mortgage world compared to what that roll-up product would have looked like in the equity release world, and that they can quantify the cost of satisfying their needs through that type of product. And then thirdly, it's about encouraging firms to make those decisions around whether they want to expand their advice offering to cover both parts of that, or the full breadth of that spectrum, or make the decision to build a referral capability. So we've spent 6 months building that ability out, having that debate in the market. We've got around 500 signatories, whether they're firms or individuals or networks, signed up to that movement now. So just want to get your thoughts on the importance of that comprehensive conversation. So why, I'll come to you first, Colin. Why is the comprehensive conversation an important tool to help advisors address the changing needs of over 50s borrowers?
I think it's great what you're doing, firstly, and I think it's much needed. And it's also one of the reasons we set up Perenna is that, lending beyond 50 is now becoming more and more important and more necessary. Actually, average life now is kind of 80. So you're spending half of your time beyond 50, half your kind of post-child time beyond 50. And a lot of equity is tied up in housing because it's a natural way to save money. We don't have an age restriction. So firstly, we wanted to come out and say, it doesn't matter what age you are, if you can afford a mortgage, you should be able to take a mortgage. And the reason for that is that with all of this equity being tied up in property, people are very restricted. And actually 50-year-olds, 55-year-olds find it very difficult to get a mortgage with a decent term. And that's what we wanted to cure. People have different needs nowadays, living longer, money tied up in property, good incomes in retirement, but they can't access that cash. It's locked up in property, and that's not necessarily what everyone wants or needs. So we wanted to introduce products that allowed people to borrow right the way through their life at any age, from young to old. I actually don't consider later life lending to be 50. As I said earlier, it's kind of you're halfway through your life, really, rather than in your later life. I consider it more midlife. And so we need to deliver to those customer needs at that age. The option in the past has been equity release, but that's not for everyone. We need to broaden it. We need to broaden it into traditional mortgages, which is what Perenna's done and other lenders have done, RIOs, term interest only, or just a standard repayment mortgage for 40 years. Our concept as well is to give stability. And I think that's also important in retirement. Your income doesn't fluctuate. It's pretty steady. It rises with inflation. You don't want shocks. So we fix our mortgages all the way through. So we give stability and no age restriction. And I think that's great for this concept, great for the movement.
And are you finding the same thing from your perspective, Emma?
Yeah, absolutely. And I completely agree with what you're saying there, Colin. And I think, I was lucky enough, I suppose, to go out on the road with Dan Holden, who heads up the Air Academy, for a number of later life collabs over the last few months. And I think for me, to hear the way that Dan articulates the power of comprehensive conversations has been really illuminating. He talks about the comprehensive conversation movement as being, for advisors to be relational and not transactional. And so to kind of, look at the mortgage almost as a journey, a financial journey, and not just that kind of one-time transaction. So you've got the mortgage being that kind of journey going through from first home through to last home, through all the different life stages that one comes across, be it, divorce, upsizing, downsizing, et cetera, et cetera. So I think that whole movement has really changed the way in which brokers view mortgages and customers. And I think the other really key thing for me here with the kind of Comprehensive Conversations campaign is the fact that it makes the mortgage market, think of the mortgage market as one entity, and not having those sub-segments of market. You've got a later life market, you've got a mainstream market, you've got a specialist market. So I think it does a really, really good job of helping lenders, advisors and distributors to collaborate a little bit more, if that makes sense.
Yeah, because that partly was what worried us in some of the original research, was there's a danger that people see it as two markets, not one.
Absolutely.
It's one. There's only one set of over 50s customers. Mm-hmm. And there are some excellent solutions to problems at either end of that spectrum. And it's an advice-rich area, and advice really is the product, not the end lender-built, financial services product. It's the advice.
Absolutely.
Really.
Absolutely. And I think that was a point that Dan kept sort of reiterating, was the fact that it's knowing your customers really well, asking those questions, listening, and just being more, insightful and perceptive as to the challenges that over 50s borrowers are experiencing today. Mm-hmm. I think I'm probably a perfect example. I'm 50. I know I don't look it in any way, shape or form, but my existing mortgage matures when I'm 67. So I've got a 12-year-old daughter, I've got elderly parents. So I'm probably one of those emerging later life borrowers that advisors are going to be speaking to in the coming years. It's quite stressful, financially, planning for retirement, smaller pensions, all of that kind of stuff. And I think this movement really brings that to the forefront of brokers' minds, which is just brilliant.
Yeah, it's good. And it's not uncommon to see sort of myth-busting work done by BDMs or by lenders in different parts of the market. I suppose what you're outlining there, Emma, is that there there are now very different customer profiles emerging in the market. So, Colin, what thoughts have you got from Perenna's perspective on kind of emerging needs for customers and typical profiles, and how they've changed, and how firms need to really think differently about some of their maybe preconceptions they got before?
Yeah, there's a real polarization now between the kind of psychology of borrowers at different ages. The youth of today, I think, are comfortable with taking debt throughout their lives. They're going to live a lot longer than we are, probably be the 100-year generation. They're going to require, income and equity right the way through their lives. They also rent everything. So, they're used to kind of borrowing, renting. The older generation, however, the kind of over 70s of today, all rush to pay off their mortgage by the time they hit 50. They're all sat on property wealth. They don't necessarily have much in savings. They have a good pension provision because that age group did have good pension provision when they were working. But actually all their cash is tied up. And then you have the 50s, which I also sit in the middle, who have one foot in either camp. They either want to repay all their debt or they're happy to carry debt. This goes back to what you were saying earlier, and really the mortgage is now becoming a tool. It's a tool to get you on the property ladder when you're young, of course, because you need it. Property prices are high. It's very difficult to get on the ladder, so you need a mortgage to buy a home, your first home. But actually it's a tool you can dip into through the whole of your life, and that's really what we're trying to expand the market into, and this is where advisors come in. You may have paid off your mortgage, but actually later in life, you may need some of that cash back out of your property. So you may want to come back into it. If you've got good income, good affordability, why not? Why shouldn't you take equity out of your property and enjoy it? Help your kids out getting on the property ladder, or just enjoy it yourself. You've earned it, you've saved it, so why not? So the mortgage is becoming a tool. It's a tool for you to release your wealth and use your wealth as you choose, rather than it just being to buy your first home and to pay it off as quickly as possible. Now, for some people, they do want to pay it off and don't want to mortgage again. That's absolutely fine. That's where the advisors come into it. But for others, there is a lot of equity, over 3 trillion of equity in the over 50 sat in property. That should be enjoyed. And there's also inheritance tax planning that can also be looked at when advising on mortgages later in life. So yeah, it's a tool. It's a tool to release your wealth, to use your wealth as you choose and as you want, rather than having it all locked away.
Thanks, Colin. And Emma, does that match your experience?
Yeah, 100%. I think as a sales team at Hodge, we're fast coming around to the idea whereby, like you've quite rightly said, Colin, the mortgage is a tool to, acquire the equity and then utilise the equity. I think that's kind of the way that we're starting to view that. And I think particularly with the kind of 50s and 60s borrowers that we're seeing now, obviously we're data driven, as I'm sure you are as well. And, we have to keep on consistently changing our products to meet the needs. And we've just not stopped enhancing criteria, max age, max LTV. We brought in repayment as an option probably about 2 years ago. So I think it's just evolving constantly, those needs. But yeah, totally agree with your point of view there.
But I'm interested in the point on the kind of changes in the psychology of the older borrower, I think. How does an advisor adapt to that? Because preconceptions of, which we drew out in our comprehensive conversations report, was that typically if you're taking your mortgage out before the year 2000, you were quite likely to be of a mindset to pay it off. By the time you were in your late 40s, by 50, have some small window, which we all know is never enough, to accumulate some pension funds and then go into a retirement phase. Post 2000, that's definitely not happened. As you both drew out earlier, people are taking mortgages out later and for longer into retirement. So how does the advisor work through the psychology of the customer in terms of their attitude to debt and to repayment?
This is the real challenge, I think, because, as I said earlier, the psychology of the older demographic is not to carry debt when they're retired. And this is where advisors really do come in. It's about trust. It's about showing them what they can achieve, have, that is safe for them, that's within their affordability, that allows them to actually release equity to spend on their needs. And it could be healthcare, it could be enjoyment, it could be assisting their children. But this is really an advisor-led market, convincing the over 60s and over 70s that actually it's fine to have a mortgage at that age as long as you can afford it, is a real challenge. It will take time, but it's also referrals. It's, one elderly couple will talk to another one and say, look what I've done. Equity Release was trying to do that, and that's one product. And the good thing now is that we have different types of products for different types of needs alongside the Equity Release type of concept. But it's talking about it. It's showing them that it's okay. It's advising people. And later in life, obviously, you do need proper advice. You need to understand what you're getting here. You are taking on a mortgage. There are requirements of that mortgage. There are restrictions of that mortgage. And elderly people need to also understand that. But I don't consider 50s and 60s to be elderly at all. So that demographic, is very much aware of what mortgages are and aware of their own needs. So I sit in that camp. My parents are around. They're in their 80s. They have all the equity in their property and no mortgage. All their wealth is there. I don't need it. I'm in my 50s and we're fine, right? They're not enjoying that wealth. It's just locked up in their home. Convincing them to take on a mortgage would be really difficult because they've just not had a mortgage for 20, 30 years. It's just alien to them.
So what more can we do as an industry to help that education process with customers?
I think there's a lot we can do. And I think, first-time buyers, for instance, so we know the average age of a first-time buyer today is 34. I think if you're based in London and the southeast, your first-time buyer is probably around the age of 37. Mm-hmm. So, longer mortgage terms, the affordability constraints we're finding today, those customers are going to be landing into retirement, there's no doubt, into their mid-70s and even longer, potentially for the whole of their life, I suppose. So I think that, mainstream mortgage advisors as a starter for 10 need to start advising on those later life products much earlier in the mortgage journey, giving them some form of consideration, because I think there's definitely a market for that. And I suppose the other challenge for advisors as well, it all comes down to being quite intuitive and perceptive. I think you just touched on it now, we're in our 50s, we're in our prime, I don't feel like I'm a later life borrower. I really don't, and I think there's a piece of work we did a couple of weeks ago and it's just gone out on social about the Queenager. And it's a new kind of like cohort of customers who are coming up. They're women, they're between the ages of 45 and 60. They're purpose driven. They want to view their 50s and 60s as a time to thrive, and live their best lives, socialize with friends, take the holiday, use the equity, as you quite rightly alluded to, in the property. So I think that as a broker, you've got to be really aware of all these nuances that customers hold with them now. So it's definitely about knowing your customer more deeply and asking more questions, I suppose, because, that traditional later life borrower who was putting on a pair of slippers, smoking a pipe, looking to go down the bowls club, that doesn't really exist now. They're very active, they're looking after grandkids, they're heavily involved in their communities. It's a completely different customer cohort now. And I think, I'm sure you do yourself at Perenna, but there's, lots and lots of tools online that all the lenders in this space offer to help brokers understand what those new customers do look like. So it's there for the taking, I think, really.
But it does mean people need to be alert to that shift.
Absolutely.
They need to be aware. So we need awareness out there. And that's, again, where advisors and firms such as yourself come in. There needs to be awareness that actually you can get a mortgage. Myth busting, some lenders don't have maximum ages. Some lenders will lend beyond 75. One of the first mortgages we closed at Perenna after we launched was to a 71-year-old who came to us and said, my lender's telling me I've only got 4 years left and I need to repay this interest-only mortgage. I can afford it. I'm paying it. I've got good pension income. And she said to us, we want to live in this house until we want to leave the house, either through end of life or moving into care or downsizing or whatever it may be. And we gave them a 40-year repayment mortgage. Therefore, the timing is in their control. It's in control of the customer and the advisor. And she's happy. She doesn't have this hanging over her that in 4 years' time, I've got to sell. I don't want to sell. She loves the house. She wants to stay there until she's ready to move on, not at the kind of bequest of the lender. So affordability is good. Why not?
You raise a really good point there as well about, looking at the customers as well. And I think that I was talking to you both the other day about my sister-in-law who's 54, lives in London, genuine first-time buyer, degree educated, her and my brother-in-law. But got some inheritance and both said to me, we're 54, 55, we can't get a mortgage. We can't get a first-time mortgage. And it's like, oh my goodness, you absolutely can. So again, I think, Paul, going back to your point about what can advisors do, it's really like making sure that customers know they can get a financial solution when they're in their 50s and 60s. And there's huge numbers of people out there who just don't think they can. And I think it's, you're doing a great job with what you're doing now, but I think there's more that we can do with trade bodies, I think with lenders, distributors all coming together to sort of get to the end consumer and let them know there are these options available.
Yeah, and that's the thinking behind the Comprehensive Conversations movement. It wasn't a one-off run for a quarter piece of marketing. It's designed to be something that's really at the heart of everything that AIR does now for a very prolonged period of time. But the view is we would get the stone rolling and then other people would be able to run with it as well. And hopefully that's what we're on the edge of now with organisations like yours, pushing the same kind of thought process and shift in mindset across the market. I think it's interesting though, where you say we need to do more to help education at the consumer level. And I think we should all own that as organisations in the marketplace. Working with other parties is definitely something we should explore. But Emma, I just want to pick up on the education piece in the mortgage broker context, where how can an advisor that has worked really hard to build up an established mortgage practice take some practical steps to put comprehensive conversations and a comprehensive conversation strategy into their mortgage review process, so that some of those things we talked about surface much earlier than 4 years before the end of a term? Yeah. What can firms do in a practical sense with mortgage reviews? Yeah,
I think there's lots and lots of things that you can do. I think, to be fair, the AIR Academy, you've got some fantastic accreditations on there. In fact, my team are actually starting to go through those themselves at the moment to make sure we fully understand everything, because that's what we need to do. BDMs, there are some fantastic BDMs out there that are all too willing to come in, spend time with firms and really talk you through the nuances of a RIO versus a term interest only versus a standard residential mortgage with a long term that can take you into your 80s and 90s. There's a lot of collateral out there online as well for brokers to utilise. And I think, I mentioned the sort of collaborative events that we started with yourselves earlier on this year. We're doing more. And that came out of that whole need for education. And I think what we're doing, we've teamed up with the Family Building Society, L&G, Standard Life, Your Good Selves, Live More. We've all come together and we're going across the whole of the UK to just get in front of brokers and say, look, there are these amazing products here for customers. This is what your customers are thinking, feeling. These are the challenges they're having. So there's heaps and heaps of opportunity for firms at the moment to get on board and really, broaden their knowledge, I suppose.
Yeah, and it's interesting though, because those firms that are proactive in affordability-led conversations are those advisors with that long-standing mortgage skill set.
Absolutely.
They're very good at understanding that position from a customer perspective and drawing out that information. So in reality, those are the people that we do want to be exploring circumstances with customers to help, the newer style products that are being developed, whether they're on a traditional mortgage chassis or an equity release style chassis, it doesn't matter. That those newer style products are going to bubble up through great conversations, and
absolutely.
Mortgage brokers have that skill set. We just need to give them the confidence to signpost the newer products and the information to be able to do it. Yeah. So it's an exciting time in the market. So I think a couple of last questions from me. Is there anything that you think AIR could do differently to help advisors build a better framework for engaging with introducers who have older borrowing customers? AIR's really good, I think, at the sourcing style, the education piece in the sense of the academy. We do have marketing insights and marketing collateral in our marketing hub, but could we do anything differently to help people go out with confidence to talk on a B2B basis with brokers?
That's an interesting one. I suppose I think it's funny, whenever we go to a collaborative event or we ever go to a network event, we always kind of encourage the brokers in the room to speak to other brokers in the room, because they could find a really good referral partner there, you know. So I think maybe there's some sort of potential events that, you know, you could get behind, where you're getting, you know, introducers together to talk about this, and then to, I suppose, encourage them to connect, collaborate. I suppose it's all about collaboration, really, and kind of bringing people together. Because we're trying to start doing that, but I think you're absolutely right. There is a bit of a gap there from a B2B basis.
Certainly challenging existing relationships on a B2B basis. That comprehensive conversation could be a B2B one.
Absolutely.
Where an established, proven introductory relationship for equity release might be bringing those traditional customers through. You might need to revisit some of those partners to be able to engage in some of this, newer customer profile activity. So, how many of our members have been to their introducers, for example, and talked about customers from 50, not 55? Redefining the later life lending landscape for those introducers. Because signposting is as important as writing.
Yeah.
So certainly an area I think we should explore in these podcasts a little bit more in the future.
Yeah.
To try and help people have that confidence to go out and talk about a broader marketplace and one pool of customers.
Yeah, and I think that's really interesting, because I think if we look at the Hodge proposition, I mean, the 50 plus started off as the 55 plus. And I think 2 years ago it became the 50 plus. And I think we're at a point now, based on everything we've talked about so far this morning, whereby we're just going to take age out altogether, because actually, if a customer is 40, 45, we're currently turning away customers. Why would we do that? You know, they need a 40-year term. What difference does it make? So I think that's been quite interesting. And I know that's, from your perspective, I think that's a big tagline for you, isn't it?
Yeah,
in terms of age is just a number.
Age is just a number, absolutely.
Yeah,
we have no age restrictions, but we're lending through the life. And I think this again comes back to the myths you were talking about earlier, and this is where you can help. There are a lot of myths, because products in mortgages are all very similar. And, we're starting to break the mold with these kind of products. Equity Release did that. We're doing that with, and you're doing that, Hodge, as well, with, with RIOs, with term interest only, with more flexibility, no max age, for example. But lending is all affordability led. And there's another area where there are lots of myths. At Perenna, we fix our mortgages through the whole life. So we don't stress for SVR because we don't have an SVR. Well, people won't remember that because everyone else is stressing for SVR. It's those kind of myths of, can I borrow when I'm 50? Can I get a 40-year mortgage when I'm 60? Yes, you can. Actually, with some lenders, you can do these things. So it's case studies, it's education, it's just signposting. Everyone knows about the standard products. We don't need to talk about those so much. They're all just doing the same thing at different price points, at different LTVs. Everyone understands that market. What they don't understand is the more specialist areas of lending. We consider this to be mainstream lending, but it's, you're lending to older people. You're giving people accessibility beyond 50. Yes, you can get a mortgage that goes beyond your life. The regulators are fine with it. Lenders are fine with it. It's just reminding through case studies, through education, through the brokers, but also through consumers. We're also educating consumers so that they go to a broker and say, I've heard about this, what do you think? That's what we do. We're pulling in consumers direct to our website and pushing them out to brokers. So we'll try that education as well through third parties as well. I think that's important.
I agree with that, Colin. That's partly where we came from with the Navigator tool, with a view that could be used by both a mortgage experience broker or an equity release experience broker, where it would help them have an in-depth conversation with the customer, be able to challenge on perceptions around what they could afford to pay versus what they wanted to pay and the benefits of making payments, and really fleshing out from an education perspective that the benefits that travel with making payments could be you've got a better choice of product. It could be that making a payment means there's an economic benefit that could be passed in terms of a lower rate or a higher LTV in the traditional equity release space, rather than it being a full fat equity release product. But without that great conversation, none of that surfaces, and the customer, doesn't get the signposting for what could be available to them later in the process. So,
assessing affordability in retirement is far easier. because there isn't the job risk that you have when you're pre-retirement. It's stable income. No one can take your pension off you, you know, and it's there and typically rising, you know, if you're in a pension scheme that's inflation linked. So it's a safe area to lend in as long as people understand what they're taking on with a mortgage in retirement. And that's where the advisors come in. Absolutely.
I think as well, you know, talking about kind of what AIR could do more of and talking about our great market. I'm very passionate about the market we work in. It's brilliant. And I think we could probably do more, I suppose, as lenders, distributors and advisors in terms of like forming the narrative from a press release perspective, from a wider market perspective. I think, you know, we all know that lifetime mortgages haven't had the best press. And I think if you look at the Rio mortgage specifically, that also hasn't had the best press. You know, you hear quite often about it hasn't taken off as the FCA thought it would, but it's actually building traction. It's establishing itself in the market. It's embedded. There's a bit more awareness now. And we're seeing Rio business uptick quite considerably, actually, year on year, 14% up this year from last year, for instance. And it's currently 25% of the business that we write. So I think that we can probably do more in that regard in terms of writing that narrative and putting that out there to the wider market, if that makes sense.
And why do you think that increase is in play? Do you think it's because advisors are embracing affordability-led conversations more?
I think so. I've noticed a huge shift in the 5 years I've been in this market, a huge shift for the positive, definitely.
Yeah. Advisors will do a case, they'll get comfortable with it, they'll do another one, and they'll talk to the people next to them. And it's, you know, it takes time. This is a market that didn't exist that long ago. So it does take time for consumers to move and for advisors to move. But the best way is by seeing one happen or by writing one yourself. Then you kind of, that worked. It was easy. Actually, it was fine. The customer's really happy. It's that kind of movement, which is a snowball effect, which I think we're all seeing. But it's also having all the different options now beyond 50 or beyond 70. Equity release, retirement interest only, term interest only, or even, you know, a standard repayment mortgage. The lady I spoke about earlier actually wanted to still feel she was paying off a mortgage. So she went for a 40-year repayment mortgage, even though she was 71, because for her own well-being, she felt she wanted to still think she was paying off the mortgage. And obviously she is, but the chance of seeing that to the end is low. So, but yeah, it's optionality. It's being comfortable. It's seeing, actually, I can do this. I've done it. Customers happy. The advice was good. Everyone gets comfortable. It takes time though.
It's that confidence, I think, isn't it? I think definitely the confidence. And I think certainly in the AR space, when you've got some sort of specific sales processes that you have to follow around interest only, just generally, I think it is quite daunting. And I think that's where the BDMs and lenders can really come in and help, and your good selves as well, to be honest.
It's also where networks come in, you know, giving them the confidence that these products are fine. Yeah. That they can advise on these products. The regulators, the same, you know, the regulators allow this. The regulators are not stopping people from writing these kind of mortgages. It's just apprehension or, lack of confidence. So, and that comes with time.
Yeah. Thanks, Colin. And we will explore in other aspects of this series the role that technology can play in helping to simplify that complexity. But it does sound as though from the conversation we've just had that education will play a massive role, both in terms of our organisations supporting the advisor and raising awareness of the different product sets that are out there, but more importantly, giving those advisors the confidence to go out and to talk to customers that there are many, many new solutions out there.
Absolutely.
My takeaway from this session is that, you know, no longer do we have that market where, you know, as you drew an example out, Emma, that, you know, people are aware that they can get a mortgage over 50 in some circumstances. Certainly some older borrowers who work really hard to make that decision to step onto the housing ladder, pay their mortgage off early, may now have a, you know, difficult family financial situation where advice could point them to a solution that would be supportive. So that we need to raise awareness there. But also those preconceptions that are out there that, you know, these later life products are for people in a certain circumstance. You know, we've got a big opportunity to myth bust that and break those preconceptions. But it all starts with advice and better supported advisors. That's certainly a role that we want to take on at AIR. to support where possible. So we'll expand the platform to bring new products on, and we'll keep increasing the resources available through our academy. But we're really pleased that organisations like yourselves have embraced the comprehensive conversation. We've had a great one today. So thank you both for your time.
Welcome.
Thank you.
And we'll look forward to speaking to you in more depth on these subjects in future podcasts. Thank you both. Thanks for listening. If you enjoyed this episode, please take a moment to rate and review us on your favourite podcast platform. Your support helps others discover the show. Don't forget to subscribe so that you never miss an episode, and follow us on social media for exclusive content. We'll be back next week with another great comprehensive conversation.